Well, hello everybody. It is August 23rd. This is the weekly review where we look at, of course, what happened, what looks to be happening, try to make sense of the bigger picture, and with respect to how it affects you in your financial activities. So, last week we finally got the big spill. All that negativity I'd talked about, for a while and really harped on even last week, finally came to realization as we got huge percentage declines across all the indexes, mirroring those kinds of declines that we've seen across the world. And that puts the indexes on the defensive and in negative territory, and in some cases from the tops, right? In bear market territory on some of these sectors and on some of these indexes, they're getting close to correction territory. In other words, all those potential negatives, all the ones we've talked about, they finally were realized, right? And that shows up on the charts. We saw those risks being extremely elevated using the charts. Let's take a look at those things. If we look at the S&P 500, as I always remind you, the risk is when you have multiple swing points that can break on multiple time frames. So we had multiple swing points, right, on this daily time frame, and it was setting up to potentially break. Now, that wouldn't be so bad if it was just on that time frame. You also had it here on the weekly time frame setting up to potentially break. And on top of that, you had 7 months of consolidation slash distribution at the top. So in other words, the markets made their move, right? They come up, they make this long run, and then they just stall. That sets up a lot of swing points, right, that can be broken, and then at lower levels, another set of them, and then there's actually another set down here at lower levels as well. And so you have this idea of multiple swing points on multiple time frames that can break. And I know from studying 60 years of history, this pattern is always the pattern that can give you potentially large moves when they break. And that's what happened. So people can blame it on whatever they want to blame it on, right? But the bottom line is these markets finally had the big break, and it was big time. And it was based on these range breakouts across many of these sectors, across many of these indexes. It was based on multiple swing points on multiple time frames that were set up and just needed to be actualized in terms of breaking them. So these range targets now are almost met. In other words, if I come look at the S&P 500, for example, this thing is set up to almost get to, it looks like about 1946 or so, 48, somewhere in there, right? It's not that far away. It's underneath these swing points, and by the way, this one actually broke as well here. This one's already broken on this move Friday, or on last week's move total. But the point is that the range extension is already well underway, right? It's already broke here and did its extension is almost to the target of the second extension of the second range. Now that doesn't mean we can't get another range, and we've talked about this before. For example, we could get another range down here that could take us down into this October bar from last year. Certainly the target now potentially is this October bar, and then you're going to see that across a lot of these indexes and in all of these sectors. Right? That bar becomes a target, and it's either the weakest sectors, it's the bottom of the bar, and in the stronger ones, it's going to be the top of the bar. And then those that are the strongest, in terms of like sectors and stuff, it's simply going to be these swing point lows on their particular charts. But those all become go-to targets. Those all become chart targets, right, that they try to reach. They being the programs, the big institutions, whatever. In other words, you will find that there's a greater reason to actually do some buying down here than selling. But don't take what I just said as an indication that you need to run out and buy, back up the truck, so to speak, and buy everything. Just look at the qualified trends at this point, right, on these two time frames. Now this time frame we know has been struggling. That's the short term. And at this point, this thing is bearish across all sectors, all stocks, indexes, right, with the exception of the utilities, which have had the counter trend move off of the fear elsewhere. But what's really changed now is the intermediate term trend, right? Those trends with this break this week, they have set up to go immediately from, in many cases, bullish to bearish. Why? Because we broke multiple swing points. That's how you can get the larger moves. Broke multiple swing points. There's very few left here. You got bullish here, sideways there, and about 4 of them total, right? And everything else is pretty much bearish. IWM's kind of hanging on given the peculiar nature of its chart. But out here, all bullish. How does this change? Well, if you think about the way markets work, right? Typically you have bull markets almost always, right? You have these bull markets that are going up and then they set these ranges up here, right? And eventually you get the break of this range. That's what we just saw. After that break, typically you're going to find some level down here, right, where this levels off, and when it does, right, that's when you'll get some sort of a bounce back up and you come back to do your bearish retest regen sequence off of that. Now recognize up here you have a lot of people that are in trouble. In other words, they've bought at a much higher price and they're underwater on their trades. Those people are underwater on their trades, they want to sell, right? They want to get even. And getting even, of course, is what pushes this back down. The larger breaks, they form this way. And they form this way not only on the daily time frames, to the weekly, they do the same thing on the weekly to the monthly, and that's how you get bear markets. Clearly, the economics has to support it. Clearly, the earnings have to support it. But eventually, that is the setup, right, that leads to larger declines. Let's look at the rest of this here. So trend transitions everywhere. The early week bounce, it gave way. The Fed spike. There was a spike reversal on the Fed on Wednesday off the minutes. But that gave way too. We just simply following what the rest of the world is doing. And we've been doing that for a while. Here's Taipei. You can see the big moves down. This is relentless. This is on a weekly time frame. Just unrelenting pressure moving from almost 10,000 down to 7. I mean, this is almost 25% at this point. Shanghai's down 35% or so. If you go to even Hong Kong, for example, if you go to Hong Kong, they're almost in correction territory with their moves down. Korea, 22 to 19 and a half, again, correction territory. Just go down the list. It's across the board. And not only is it there, it's going the other way now, where Europe is seeing the same issues, right? I mean, we've had a top up here, 12,400. Now you're sitting at 10,100. If you do the math, right, we're talking correction territory easy. We're doing the same in London. We're doing the same across Europe. Nobody's immune. Almost 500 on the CAC, which is almost 10%. So corrections everywhere. It's just starting here. So with these declines, right, we've got a lot of people now that are underwater, right? And that's going to put pressure on them to sell once this changes and we get some sort of a bounce. Now, I don't want to be all doom and gloom because I don't think that does any good. Matter of fact, what we should always be doing is looking to what's coming, not what's already here, right? It's like playing soccer. You pass to where the person's going, not where they are. And we have to be forward thinking, right? Looking at it that way. And there are some positives that we should consider. For example, we have a market that still is bullish on the long term. In other words, our long-term perspective has to be bullish still, even at this late point. Now, if we get that sideways move on an intermediate term time frame with a large range, and then eventually set up the potential for those breaks farther down on the long-term time frame, right, then that would be a different story. And what I'm talking about here is if I look at the S&P 500 on a long-term time frame, right? We've just started to get a move back down. To get something serious, we're going to have to break multiple swing points on this time frame. So it would be these two swing points at this particular point in time. Those swing points are still 150 points away. We just did a 150 point decline. So in other words, we've got to double that just to get to the point where we could break these swing points. So yes, it feels painful, but at the same time, you got to almost double what you've already done to get back to the next set of swing points, right? To even get this thing to even think about a trend transition on this time frame. And you can see it here. It's basically a range at these lower levels. We're at the range. If we break down, get underneath here on a monthly time frame, then we can seek the bottom of the range, and that, of course, could set up the potential for the end of this bull market. That's the setup. Going to take a while to play out. It's a monthly. It doesn't happen overnight. But that is a positive if you think about it, because it's going to take a heck of a decline from here just to get to a sideways or potentially a bearish trend. The Russell 2K actually traded under and over on the weekly time frame. So this index is already doing the test, right? And that test, it actually failed to get under it. Volume here compared to volume there was not the same. It was lighter. You already had an ABCD extension on this index, unlike most, and it more than completed already. So you can see this at this point, this is fairly oversold and it has a decent support zone up underneath it. Another thing that we haven't looked at in a while is that we actually have, kind of a extension on the mean time to failures on a couple, or actually three of these indexes now. The Dow, the S&P, and the Russell are all set up, extended on the short-term time frame to the downside. And then some of these sectors are almost at or have already reached their targets in terms of ranges, right? You had this range, now you're into that one already. You got the break here, you held for a little bit, now you gave way. Coming in towards the bottom of that range, towards the bottom of the October lows. So in other words, you're seeing the extensions play out to the point where they're almost to where they want to go. And as I already pointed out here on the world markets, we've already seen losses 10 to 15 to 20% in some cases. So we've already got corrections, and in some cases already have bear markets in those other world indexes. Now the negatives, of course, there's plenty of negatives. We've already talked about a bunch of them. We talked about the wipeout of a year's worth of gains, or maybe we didn't talk about it in that term, but look at this. This is another way of looking at, the wipeout. If you go back a full year, July last year, right? At that point, you still had trades that were under. But you had a few trades over, and then from here on, everything was over this price point. Now, with the price down here, all of these positions are underwater, right? That's almost 10 months of positions that are underwater, and just a few that aren't. You can imagine if these break, especially this one down here, you're going to have multiple years that are underwater, and that's how larger corrections take place. And finally, if we zero in on China itself, right, we already had this big move down, now a bounce, right? The potential is for another large move down. And believe me, if this comes immediately, we're not going to get a bounce of any significance in our markets, because the fear right now is China. And if you take this range and you line it up, right, and then you do the range inside of it, that's about that much, you can expect another one to take you down about an equal distance, which is to the bottom of this support zone. That is not a small number. We're talking about under 3,000, right? So we could drop another 20% on this market if it starts to really roll, and that will catch the world's eyes. If we turn our attention to the positives on the fundamentals, you got economic data here that remains mixed. It's not that bad. It's not that good. It's in the middle of the road. But expectations now probably are starting to shift where we don't need to price in a Fed hike anymore. And that, I guess, is a positive if you think about it, because for so long we've been worried about that. Fundamentally, the negatives, you've got pretty much slowing growth around the world. I just saw Japan's number this last week. Their exports suffered. Well, why? Well, Chinese devaluation, right? It's going to take some of that export away. And that had been happening, and that's why all of Asia is struggling as it is. The earnings season's over, and year over year it was negative. So you got slowing growth around the world. You got negative earnings, even though they quote unquote beat, right? They were negative year over year in most quarters. You don't have much growth in the earnings, right? They're squeezing more out of what they have mostly, and that's why we've had so many takeovers. And there's not a lot of positives in terms of the U.S. growth. So it's not a positive situation on a macro picture, positive in the sense that you can expect these markets to sustain as they have, because so much of that suspension, that expansion that took place in the equity markets was a result of quantitative easing. Now, we still have quantitative easing. That hasn't gone away, and you can rest assured, and that's the thing you almost have to bank on, is that, these powers that be, for lack of a better word, they're not going to sit idly by and watch the markets crash. They're going to step in, they're going to intervene, they're going to do the same sort of thing you see in China, but not as blatant. They're not going to go in and directly manipulate the markets. They're going to manipulate information, expectations to try to move those markets in those ways. And so, if I look at the coming week and I look at it just technically and say, okay, what needs to happen? What you're going to want to look for is some sort of positive divergences that start to take place. For example, if I just look at an intraday, over the last week, for example, here with the Russell and with the S&P 500, what I can see is that there was a little bit of divergence starting to take place right at the end of the day on Friday. The blue is the Russell, that's this one, and then the black, of course, the S&P. Now, what we saw was the Russell outperforming here on the bounce, making new highs, whereas the S&P couldn't, right? The S&P, let me draw it a little bit cleaner here so you can actually see it. Here's the Russell, right? Here's the S&P. So you could see the S&P couldn't break higher. The Russell did. That's positive divergence. Right now you have the potential for a positive divergence in that the Russell is going to potentially, we'll see Monday, right? But potentially set a higher low, whereas the S&P is a much lower low. So when I look at that, that's what I'm looking for. I'm saying, okay, when do I see some divergences that give me an indication that all the markets want to do the same thing? How does that happen, or why does that happen? Well, the reason it happens is because people find value on the Russell at this level. It's become a point of significance. And if you come back to the TA Today charts and look at it, what we pointed out just a little bit ago here on the weekly chart is that the Russell came in to test the swing point low, and that was an area that people were willing to buy. Now, maybe that's because this one has come down so far already in terms of an extension when it should have stopped about right here. It just kept going. So it's quote-unquote oversold. That's how you get bounces, right? And so I wouldn't be surprised to see this particular index be the one that shows that positive divergence and potentially sets up some sort of a tradable bounce. And believe me, you can get a big bounce now, right? Because you just got a huge decline. So we want to watch for those reversal setups, right, with a positive divergence and a two-bar reversal. Any under-over at this point is more than likely a two-bar reversal on any kind of time frame because of the extensions down being so fast and so furious in all these indexes. I mean, we just saw in 4 days, 6% or so clipped off this market. That's a major index, broad index, huge declines in a very short period of time. Of course, the other thing that we need to watch is how the bounce develops, because that's going to give us the bigger picture about what's happening on the larger picture. And I've got the weekly up now. If we go back, right, the range was here. That was the break. You want to see how the bounce comes back in. Does this thing come all the way back up, straight up? Does it just come a little ways up and then break down again and do some more testing? Maybe not break down, but do some more testing in this area. This is a more dangerous setup if it does that, right? What you really want to see, if we pull this to the daily chart, is you want to see the set up some sort of an ABCD structure right back to the top side. So in other words, you get some sort of, something in here that's a little ABCD structure. Maybe it's bigger and it can take you all the way back up to the point of testing retest regen. So in other words, we have these lows now that were broken up here, right? Those are going to be bearish retest regens on the way back up. So what we want to do is say, okay, does this thing put in some sort of structure like this that gets it back up into here? And how it gets there, how that bounce occurs, whether it's like this or whether it's a little small one down in this area or whatever it is, we're going to have to read that pattern to make sense of it and to tell us, okay, is this simply going to do some sort of a continuation move to the downside and this is going to get worse, or is this it? There's nothing to say that all these problems that we see could simply just disappear again. I mean, that's what it's been for, 4 years, 5 years? So don't read this as we have to go down farther. I mean, certainly it looks that way now, and certainly that is a possibility, but the next bounce is the bounce that will give us the indication if that's the more likely scenario. So we can't just jump to that conclusion is my point. If we turn our attention to next week, Jackson Hole is probably going to be the headline that happens end of the week, over the weekend. I think that's where the Fed's probably going to give us an indication of whether they're going to do something or not. And boy, if they do say they're going to raise rates at this particular point in time, I guarantee you the market's not ready for that after this week. So that will probably be the headline of next week. Turning our attention now to the bottom line. Last week I warned that, we had the highest probability that we'd had in a long time for this market to actually push and push hard to the downside. And I didn't know it was going to happen last week. I just knew the potential was there, and I knew that the risk was real. And I really communicated that to you. Hopefully you took that to heart and acted on it and positioned yourself at least not to get hurt by what was taking place, if not to profit by it. When you look at this technical damage, right, this kind of a drop this fast, right, this heavy, this much liquidation, as a technician, at least an old school technician, your immediate thought is, okay, get the bounce, short it. That's the scenario. That's always what you think. Because you've had this huge range now that has finally been broken, and it's been broken decisively. That has been the wrong trade for so long. In other words, if we go back to October last year, for example, where we saw a big decline, right, immediately bought, and not only bought, but bought viciously over the next 7 weeks or 8 weeks. And not only did it take a 200-point decline and turn it into a 250-point win, it did it in a V-shaped manner, which we have seen over and over and over. Is this just going to be another one? Are we going to see another one? I think this is a little different, and the reasons I say that I've listed here that you can read. But essentially, there are 3 major differences that make this one harder. One is you had a large, long distribution pattern. So in other words, you came up here, this thing had distributed now for 7 months. That's a lot of inventory that got moved from one set of hands to another, more than likely. That is what distribution is. It's where the guys that really are keen on what's happening, they start getting rid of stuff, and then boom, they just let it go. Now, if they have more inventory that they still need to get rid of, in other words, they held it as long as they could, and then it just fell and they couldn't do anything about it. What they're going to want to do is they're going to want to buy this area down here and drive it back up as close as they can up into this area, or maybe a little bit higher, and start distributing it again or dumping it again. That's the way tops are made. And the large players are the ones that make the tops. When they all, not all, but most of them come to the same conclusion, and that is that it is a top and they don't want to be holding that inventory through some sort of a larger correction. because they have millions and millions of shares. They can't just get rid of them all at one time. It's not like you and I, where we can go to cash in 10 minutes. I mean, it takes them weeks, months to go to cash or to get closer to cash. So the fact that after 7 months of what looks like distribution you get the break, that's a significant difference than what we saw last October. It was the first larger decline off the highs last October. This is the second time now within a year. So in other words, when you see a repeated pattern, right, then it's different. That first decline is usually not the decline that's going to kill you. And again, if I pull up that weekly chart, this first decline, this was the first significant decline off of 4 years of up. Now you get the second significant decline after 4.5 years, 4 and 3/4 years maybe. And finally, on the October lows last year, right, even though it did break multiple swing points, in other words, it broke this one on this time frame and on the daily time frame, there were some other significant swing points down in this area that it tested and held. It didn't give them up. Well, this time it's a different story. You've broken 2 here. You've broken multiple ones on the daily. And so when you look at it from that perspective, right, it's different this time. It doesn't look the same. And so if I had to make the bet, the odds-on bet as to whether this is different or not, it does feel different. It does look different from the way it's structured than it was last time. And that makes me think that what you're really going to see here is you're going to see a bounce is more like a bounce from the past, in that you come back up to do the retest regen, and this time it actually fails. And I would take the overlap area, and let me draw it right in here. I would take this overlap area as the key area. So about 2070 on the S&P. The best bounce I could expect might be up into that area, which kind of brings me to the viewer question. So let's just tackle that while we're here. And I should say member question, really, not viewer, because only you members get to view this. How much of a bounce can you expect? I've laid it out here so that you can read it in the attached notes, but I want to show it to you here on the charts. And I'm going to use an intraday chart using the S&P 500 because I can't do them all, and this is probably the one that most people tend to watch or should be watching. I've got an intraday chart up using the profit charts I use sometimes. This was an area of congestion, right, yesterday or Friday on the way down, right? And so this area is the first area that you have to get over. That's the first hurdle. That's the first test, so to speak. And then after that, then you can think about higher levels. But that's the first bounce test. And that would be the logical area if we're going to just continue straight down to see a failure. So that's first bounce. That should come fairly immediately unless we really get some sort of crash taking place in Asia overnight tonight. Where can it go after that? Well, the next place is this logical little gap down on Friday, right, which gets you almost back to where the retest regen zones are. And so that price point is about 2035. Now, if I move this over and say, okay, what does that look like on our charts? You have this price point now, which is 2045. I talked about 2035, which was the gap down area, and then the first bounce, which is right in here. So those are the places, and if you line them up on a daily chart, you can actually see that they're, it's always kind of fascinating to me, but I know I use intraday charts when I'm trying to time something, especially if I'm day trading, but swing point high here, right? You were doing a bullish retest regen on it. It hadn't broke yet, so that's what this was. Yet on this particular push down on Friday, low here was 1978, and we closed at 1970, so we actually did not regenerate on that swing point highs retest regen. This was the third time. Third time many times is a charm. So you get under it. What's the logical point? Well, get back to the top of it, 2019. That's about where that first congestion area was. It's a little bit higher. I mean, that congestion area was about 2005 to about 2010. But that would be the logical place. So in other words, I would expect some sort of a bounce to take me somewhere into this. Now, if that doesn't hold and we just go down, well, you can see how that looks, right? That's pretty ugly. And that would take you down in these October bars. That's worst case probably on a bounce. Now, of course, worst case in general is just continue down. That's not a high probability case though. So bounce to that area. Now, if you got a really good bounce, what you would do is you would get a bounce to there, some sort of a pullback, and then the little ABCD structure that takes you back in to do the bearish retest regen zone. That would be that to me is probably the most likely scenario, and it plays out over multiple bars. In other words, it takes a couple weeks maybe to get back to there. That if you do it, if you do this straight back up, that's probably going to fail. The more bullish case is up, down, right? And then you're working your way higher, and you get back up here, and you still have some juice to try to get into the meat of it. That's the more bullish case. So we'll have to see how it plays out, but those are the numbers. They look like the 2020, the 2000 to 2005, maybe 10 range first, and then over that is about 2035. Best case, maybe 2045 into the bottom of this bearish retest regen. I would look at the 2045, maybe even 2070 as the best case. And I'm not talking about next week, but I'm just talking about bounce in general. If it's just a bounce. Of course, if it's another one of these V-shaped moves, well, all bets are off, and of course we make new highs, but that's a very low runner case. So the point is if you didn't take things off and you need to lighten up, I would use the first bounce as a way to lighten up. Because you can always, if this thing does continue higher, right, just think about the way it's probably going to play out. If you take the first bounce and you come back up into this area and you sell some here, and let's just say it continues up, more than likely it's not going to be able to break above that on this first leg up, which would give you some sort of a move back down that could get you higher. And then you simply buy back what you sold in that case if it still looks that way. So use the first bounce as a way to lighten up if you didn't lighten up before this took place. Of course, if you did lighten up already, or if you had tight stops and you got out and you're mostly cash, you can actually think about trying to play this first bounce. In other words, we're here in an area that should find some support, and we should see some sort of a bounce off of that. And if so, then we should be able to trade that. And even thinking longer range, if that's really the case, and if this really was a big distribution top, then what we're going to want to do is look to this area to short it on the bounce. And so those are kind of the scenarios that play out in my mind. Depending on where you are and what you hold, dictates how you trade what has just unfolded. Now, as far as the TA Today portfolio, there's not much exposure, and we can try to take advantage of it. It looks like I left the RWM off of here. I'll add that back in. But the RWM we added, which was short, which is making some money, we were able to take the spread trade on gold strength and be able to put that spread back in there. And so even though this is still a net loss with the dividends, it's getting pretty close to even though it's taken a couple months to get it that way. I do like this longer term as a trade. I don't think I'm going to move out of it anytime soon because I think it's workable and that you can actually make money over the long run. EUO we still have, which right now doesn't look that good, but there will be a point where it makes sense to add to it again. HEDJ, which is Europe, I did lower the stops you'll see in the portfolio a little bit. I want to try to stay in the trade because we don't have any inventory. In Starbucks, I added some more on weakness. Of course, it got weaker. I will want to add more again on weakness. In general, I'll probably have an order in tomorrow to take out that RWM, right, the short on the IWM, and actually get long the IWM because it's starting to show that positive divergence, and that would be a tradable, trade that we could use, right, to try to take advantage of what looks like some divergence that's going to take place here on the Russell this week, and give us a potential bounce back up into actually this low potentially, but probably not, somewhere around, I would think, maybe the 1190 area at best. But that's a fairly significant bounce, right? You can catch 2-3% if your timing's good. And of course, on the portfolio, the overnight portfolio, the TA Today portfolio that I'm talking about here, it's harder to do that, right? You need to be a little bit more agile. You need to see it test those lows, get the positive divergence intraday, so forth. But you can put staggered orders on the assumption that the ranges have expanded, right? The projections have expanded to the downside, and use that as a way to muscle into a trade on even a portfolio where you don't have as much flexibility like we do in the TNT room. So you'll probably see me do that trade. As far as strong and weak sectors, there's not much strong anymore. Most everything's weak at this point. Okay, I've made a long show here. I'm going to cut it off at this. The world's not coming to an end. The powers that be will step up. They always do. It's just a question of, will the exogenous event overwhelm the authorities? Will we see, say, China make a misstep and really put this market into a plunge? It's possible. It's not the likely scenario I see when I look at these charts. But anything's possible, so you can't just assume. If you're going to take a trade to the long side here, you have to have stops. You've got to always have some point where you say to yourself, it's wrong. And what you want to do is you want to have those cases where the probabilities are fairly good that you're going to get what you're looking for, and the reward to the risk is high. And so a trade on a bounce trade, you get that if you can set it up right. I did the Disney bounce trade. You saw how I was trying to set that up. If you haven't seen that already, you can go over to the site, right? Pop in here to the communications video library and just scroll down. And let's see where they are. Here's the Apple one, was the original we've done. Here's the bounce trade. So this was a retrace trade. This is a bounce trade. Maybe we should have done the breakaway trade on the downside, because those probabilities are high, which is what happened last week on the markets. That one actually did set up, and we should have covered that one probably first. But in the markets, there's always another trade. So as long as we learn how they set up, then over time we can all be profitable as a result of them. Thank you so much. If there's anything I do to help, let me know. I leave it at that. Take care. It's going to be a busy week. Probably a lot of opportunity and some more risk. Take care.